Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Nick Tannura, Chief Investment Officer at GSI Capital Advisors and Portfolio Manager for the ALPS Active REIT ETF, ticker REIT, R-E-I-T. Nick, it's great to have you with us. Welcome to Trade Talks.
Great, thanks for having me.
REITs were one of the best performing investments of 2021 at 43%. What were the key drivers of these returns and what do you expect for next year?
So REITs had a great year, as you mentioned. Part of it was the recovery from the pandemic and the drop in 2020. Fundamentals were very strong, and certain property types, as the recovery ensued, did really well. So things that were geared towards either initially stay at home and then recovery, like retail, residential, and certain kinds of residential. For example, the single family rental business did extremely well. And in order of magnitude, some of these sectors and subsectors of real estate were up anywhere from 50 to 100% during the year. As we look forward, we actually expect another good year. We don't expect a repeat of that. That's kind of a once in a decade, once in a 20-year kind of return scenario. But as we look forward, REITs and real estate are reasonably valued. They're actually attractively valued to fixed income alternatives. So spreads to interest rates still remain pretty wide. Dividend yield for REITs are around 3%, and operating cash flow yields are around 5%. And more importantly, the growth in that operating cash flow is really high. So anywhere from 7% to 15%, depending on the property type. And those are growth rates we typically do not see in the real estate business. And so we're expecting a positive year, especially as we've just had a little bit of a downdraft in the month of January. So from this start date, REITs should do very well.
Two issues top of mind for many investors are how to invest in an environment which might include higher levels of inflation and rising interest rates. If this were to occur, how would you expect REITs to perform?
So I think most people think, and most investors think, REITs in real estate is a good inflation hedge, and that's generally true. Part of the important thing for me is to understand why they're a good inflation hedge and why this would occur. And the largest component of that is the replacement cost theory. So as inflation goes up, the components to build a property go up: lumber, copper, et cetera, labor to build that. And so as the replacement cost for a new property goes up, the economics to make that justifiable and get an adequate rate of return have to go up as well. So that pulls rents up, or it decreases new development, which just strengthens the market. And so that's a very good barometer in a way that real estate, you can have confidence it will be a good inflation hedge. And the other components have to do with leases, the types of properties. So some property types are sensitive to GDP and growth. They have shorter leases. Take hotels as the obvious one, one-day lease, so to speak. And some of the leases have inflation links to them. So there's a base rate plus X% of inflation. And so when you put that together, as inflation goes up, REITs and real estate should go up and do well. As to interest rates, there's some expectation for rates to increase. And as I said, the spreads are wide. So real estate is reasonably attractively priced. And as long as rates are going up because of economic activity, real estate does very well, and REITs tend to outperform in rising rates environment, which I think is not well understood.
Right. And many investors have an allocation to private real estate in their portfolios. What are the benefits of also having REITs or listed real estate in one's portfolio?
So the institutional market, which is where I've been the bulk of my career, investors have a mix of private and public, and it's well accepted that that's a beneficial way to structure a real estate portfolio. And we believe investors should have both in a well-diversified real estate portfolio. A couple of the reasons we like the public market: well, first of all, it's outperformed its counterparts on the private side, like for like, so certain kinds of companies and certain kinds of property. The public market has lower fees, better access to certain platforms, and perhaps the most important part of the public market we like is the diversity of property types and exposure to what's called non-core property types. So more recently, things like data centers and cell towers. These businesses have done really well in the public market and have outperformed. And in the residential marketplace, things like manufactured housing or single-family rentals have also done really well and have grown dramatically in the public market.
And one of the longstanding trends in the investment arena is increased passive investing, generally utilizing ETFs. You have a long history as a portfolio manager in the REIT space and embrace active management. In fact, approximately a year ago, your firm, in conjunction with ALPS advisors, launched an actively managed ETF in the REIT space. What was the thinking in taking that route?
So we like this route because, first of all, in our space, the REIT space, active management has been shown to outperform. So in our part of the capital markets, it's still inefficient enough where active managers can do well. And in addition to our firm, there's other firms that have good experience and have also shown the ability to consistently outperform. So we think this is a part of the markets where active management should continue to do well. And I think the benefits of ETFs are pretty well known. You can look at other firms that focus on ETFs and the dramatic growth that they've had. And so we think it's a natural extension to bring active management to the ETF side. And in the long run, our view is sort of the investors win, the investors get what they want. And in this case, we believe an actively managed ETF is a cheaper, better product, and the investors will demand it, and over time, the market will go that direction. So we feel like we're ahead of the marketplace.
All right, Nick, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you. Thanks for having me.